Silver's at $90. Every time silver does this, it tops out and then it corrects for 20 years. And, I'm not going to touch it with a 10-foot pole kind of attitude. And that's actually wrong. We're early. The best, and I can give lots of reasons why we're early, but I think we'll kind of start there. Like right now, I can find 50, which is amazing to me, 50 very high quality 5-baggers and another 25 high quality 3-baggers. And then we can go another 25 high quality 10-baggers. We're early here. Newmont's a little over $100. I feel that it's easily going to 400. So that's a 3-bagger from here. Not quite a 3-bagger, almost a 3-bagger. Mm-hmm. But if gold goes, that's at $6,000 gold. So if gold goes even higher than that, some people think $7,000, $8,000 gold. So Newmont, which is a Bellwether, still has that kind of upside.
Despite silver trading near $90, dismissing the sector based on past long-term corrections is a mistake. According to precious metals investor Don Durrett, the current cycle is still in its early stages. He highlights a rare opportunity where dozens of high-quality mining stocks offer 3, 5 toe, and even 10-bagger potential. Bellwether stocks like Newmont, trading just over $100, could rise toward $400 if gold reaches $6,000 or higher. With some projections calling for $7,000 or $8,000 gold, the upside across silver and gold equities remains substantial, reinforcing the view that this is not a top, but a beginning. Now, we present the clips from Don Durrett's interview. Before we continue to discuss this, please subscribe to our channel and activate the bell icon for timely updates. Thank you and enjoy the video.
If you look at the fundamentals of gold and silver, they basically, in my opinion, scream that gold's going to trend upward. When the gold's not, the trend is up, not down. And that's not, if you look at the macro that's kind of pushing gold, there really isn't any macro that says gold's going lower, right? Mm-hmm. You don't see it. So the chances are pretty good, probability wise, that gold's going to go higher, silver's going to follow, and the multiples are going to expand as the balance sheets improve. And so this is kind of a best case scenario for investors. So I've been waiting for this for decades. I thought we were going to get it in 2011, 2012, but it didn't happen. It would have happened if the economy wouldn't have came back up. But the Fed basically, we didn't have inflation back then, so the Fed could take rates to zero, print at will, and basically get the economy back on its feet again. This time, it's going to be a lot harder for the Fed. So there's a very good possibility that this bull market kind of has legs here and could go all the way to 28, 29. The S&P is high. Gold and silver are going to be high. They're kind of, because gold's been correlated to the S&P since February, March of 24. And so since they're correlated so strongly, in February, I'm anticipating between now and middle of February, some of the earnings will come out late February. But over, say, the next month, I expect the S&P to kind of hang in there and not have a significant correction. I don't think we'll have one until March. So if we're right, if the S&P hangs in there and even goes a little higher, gets above 7,000, 7,100, anywhere in there, then gold is going to maintain these levels, 45, 46, maybe even 4,700 in February. The one key to earnings is the market it looks back at the last quarter, and then it looks forward to the next quarter. It doesn't really care about, 2 quarters back, 2 quarters ahead. It's the market. The people that control the market are the traders, and the near term controls everything. One little bad news release and the stock goes down 5%. Like Aya, they came out with a news release saying that their chairman was leaving and he was 80 years old and he's retiring and the stock goes down 5%. 5% on an announcement of the chairman's leaving. It's so everybody is so short-term focused. And so, but example after example of that, a company like Northern Star, they missed on their production for 25, and the stock goes down, like 10%. It's like, look back and then look. We're only going to look forward 1 quarter, but Northern Star has a beautiful project called De Grey. I think they might have renamed it. That was the company they acquired. They acquired De Grey. They're building that right now, and the market's like, we're not going to give you any value for that because you're not going into production next quarter. So the stock goes down, because they missed, and yet they have a project that's coming online that more than offsets the miss. And the miss isn't even that significant, but yet now the stock goes down. This isn't, my point is that the market is very, very short-term focused, if you will. Mm-hmm. And so going into February, because they're short-term focused, if the S&P stays at these levels, and then they announce the miners, especially the gold miners, silver miners as well, they announce their earnings, which are going to be good, then they could pop pretty significantly here. So we could see, we're going to find out, some of the big names kind of announced first, Newmont, Barrick, Agnico Eagle. Mm-hmm. They'll announce, and it's possible that we could start to see some multiple expansion. In other words, we could see Newmont possibly get to an 11 or a 12. It won't go better than a 12, but we could see it get to 11, maybe a little higher than that, as Newmont basically bounces in tandem with the stock market, in tandem with gold being higher, and then in tandem with, people starting to recognize that gold's probably, you're not going to correct. But right now, Wall Street, so I'm expecting really solid earnings. So the average gold price in the last quarter was $4,150. So $4,150, that's about $1,800 margins. Those are pretty darn solid. That's average. So some companies are going to have $2,000 margins plus, mm-hmm. which is pretty amazing when you think 2 years ago gold price was $2,000. Now we have $2,000 margins. So I think the earnings season is going to be really good. But you don't want to own these mining stocks. This is probably the better takeaway from here about earnings season. Okay, the earnings season is going to be very, very strong, and these miners are probably going to tick up a little bit. But people are ingrained with this idea that you make money quarterly and annually, and you're always trying to make money. You're always trying, your portfolio always trying to go up, 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 up. That's not what mining stocks are about. Mining stocks are cyclical, speculative bets. You shouldn't even be playing with this stuff. You should only be invested in gold and silver mining stock if you're willing to lose money, not expecting to make money, willing to lose money, especially be willing to be underwater. Most stocks, I would say 90% of the stocks I've ever bought have been underwater at one time or another because of the volatility, the nature of this stuff. These are not strong companies. These are companies that are totally dependent on the price of gold and silver, which goes up and down. And so you shouldn't even really be that concerned about quarterly earnings.
Gold and silver fundamentals continue to point higher, with macro conditions offering little evidence for a sustained downside trend. Persistent inflation, pressures, constrained central bank flexibility, and strong correlations between gold and the S&P 500 suggest precious metals can remain elevated if equities hold firm. As earnings season approaches, gold and silver miners are positioned to report strong margins driven by record average gold prices. However, mining stocks remain cyclical and highly volatile, often reacting to short-term news while ignoring long-term project value. For investors, this environment favors patience, realistic expectations, and an understanding that precious metals equities require resilience through drawdowns to capture full-cycle gains. Let's get back to the interview.
If gold goes to 6, 7, 8,000, that mine down in Brazil is worth a lot of money. It would have generated a lot of free cash flow. I don't care how high the ASIC was. You get to $7,000 gold. I mean, you're talking 250,000 ounces of production. Do the math on that. I mean, the free cash flow would have been absolutely huge. But, these companies, they tend to be conservative. They wanted to match their peer group. But I'm a fan of Equinox. It's actually one of the undervalued majors. It's going to be a strong performer. They have a nice pipeline too. Their pipeline is to grow 500,000 ounces. So they're currently at 750 and their pipeline is to add 500 to go to 1.2. I think they'll get there. And they're going to do it through quality mines. So I'm a big fan of Equinox. What's the underpinning of gold and silver? I would say 75% of the value of a company is gold and silver. And the underpinning of gold and silver is kind of the overall macro data. What drives gold and silver, right? If gold and silver prices right now were under $3,000, I might not even be talking to you. Gold and silver are the whole price of gold and silver is the key to it all.
We may not have any viewers at that.
Yeah, he might not. Nobody's even interested, right? So this is all about gold and silver, and it's not about quarter to quarter. It's more about year to year. I always say, focus on the prize. Like, for instance, 1911 gold. They really haven't performed well. That's a development story in Canada. They haven't really performed well since August. So all the other companies have done, 100% up or something, and they're like flat to down. And people are saying, this is my worst performer in my portfolio. We don't own 1911 gold for the near term. We don't even own 1911 gold for 2026. It's irrelevant. It really is. We own 1911 gold because we're speculating on its potential. And its potential can only be realized in the future. It's realized through two things. Well, we can go three, but really two things. The first one is that they have to get into production, right? Until they're in production, it's a nothing burger, right? We're not going to get paid. It's a development story. So until they get into production, we're just sitting here waiting, and we're watching and waiting. We bought it because it was a story we liked because we saw the potential. Okay, so the first thing is getting into production. The second thing is the price of gold when they get into production. Yeah. Right? So they're going to get into production in Q1 27, most likely. Once they get into production, if the price of gold is over $5,000, they're going to have high margin. So the third thing, was the third and final thing, is the first quarter results, when they show their free cash flow. Now, they're mining in Canada, in Manitoba. So if they throw out, $100 million in free cash flow, they're in Canada, right? Gold prices are 5,000. They're going to get at least a 10 multiple all day long. Right. And so that's why you got to know why you own the stuff. Right. And so that's why you own it. You own it for the future. You don't own it. So what if it's not performing in 25 or 26? It doesn't matter.
Gold and silver equities derive most of their value from underlying metal prices, not short-term earnings noise. If gold rises to 6,000 and 8,000, high-quality producers and developers could generate massive free cash flow, regardless of higher operating costs. Undervalued majors like Equinox stand out due to scalable production, growth, and strong project pipelines. Development stories, such as 1911 gold, highlight why patience matters. Value is realized only when production begins and metal prices are favorable. Mining stocks are long-term, cyclical investments driven by macro forces and future margins. Investors must focus on the end goal, not quarterly volatility, to capture outsized gains. Share your thoughts on their analysis in the comment section below. If you find this video informative, please support us by turning on notifications to stay informed about our latest videos. See you in the following video. Thanks for watching.